Ian Quigley is a partner and senior consultant with the innovative financial advice firm Cube Consulting. He is an expert in investment, insurance, and tax strategies and has developed numerous online courses dealing with these subjects. Some of the courses developed by Ian include insured annuities, small business healthcare, segregated funds, wage loss plans, and innovation group benefit plans. He shares with ILStv his views of the year that was and what we can expect in the financial world in 2010.
Well, before we look ahead at 2010, let's take just a second and look back at where we've come from. That'll give us context. And you know, 2008 left most investors down a fair bit. The TSX was down 33% in 2008. And you know, that really tied us for one of the worst 3 years ever in the stock market's history. 2008 also brought us to the end of a 10-year period, going back obviously to 1998 to 2008, which was the worst 10-year period ever in the S&P 500's history. So that left a lot of people pretty gun-shy. Going into 2009, we've seen, thankfully, a very large rebound. Into the end of November 2009, the TSX is up almost 16%, so that's pretty exciting stuff. But you know, a deeper story can be found if you look at the precious metals and the precious metals peer index. The precious metals peer index was also down in 2008, so it was down 35% in 2008. And now, coming into the end of November 2009, it's up, if you can believe this, 104%. And so this is making many of our investors and our clients in Canada just crazy, metal crazy, gold crazy. And this really leads us to the true challenge that a financial planner is going to have going into 2010. We're either going to be helping clients with fear, because it'll be a down market, or with greed, because it's going to be an up market. And really dealing with fear and greed is a primary part of our role as a financial planner. And so I'd really encourage financial planners to look at things like papers that are presented and published by organizations like the World Gold Council. The World Gold Council is an industry group, and so they're going to publish papers that are going to promote the sale of using gold as an investment. And they've published some really good papers in the last year. And so just recently they've published a paper about what role gold would have in an investment portfolio, using it as an inflation hedge. The particular paper I'd like to talk about is one that was published by Natalie Dempster and Juan Artigas, and it's published at gold.org. Well, after many pages of interesting reading in their particular paper, they conclude, and remember they're biased, they want to promote the use of gold in investment portfolios. They promote gold all the way up to 7% of your portfolio. 7%, like that's it. And so really we have to give that context to our clients when they're going all metal and gold crazy, is that it's a back to the basics type of advice in 2010. We need to deal with that greed if the greed has come back, and to say, gold could be a good investment, and we can find some papers to show our clients to support that this is a good idea. But obviously going beyond something like 7 or 10% might be beyond the risk profile of a particular account. So as markets are recovering from this 2008, I think just reminding our clients of the importance of sticking to their investment plan is sort of a back to the basics type of advice. Reviewing with them the implications of their asset allocation decision. This is how much money they have in the stock market. Is that risk profile that they have in their account matching their personal psychological profile? Are they staying awake at night worrying about things? And if they are, we need to help them go back to the basics and review their asset allocation decision. So for more information about the back to the basics, retirement and investment planning, check out some of our courses available to you where you can earn CE credits and refresh some of your skill set with these back to the basic ideas.